Hello there, my friends, and welcome back to another episode of TA with MK. My name is MK. Now, in today's video, which is part 2, kind of a follow-up to our part 1 video that I made a few days ago, which was kind of when will the bear market end? When is the best time to buy Bitcoin or crypto or stocks, so to speak. Now, in that video, which I'll leave a link in the description for, I would recommend watching it first. In that video, we focused exclusively on Bitcoin itself, specifically the Bitcoin halvings, talking or identifying that as potentially a good time to accumulate Bitcoin, for the long term, or at least for the very next bull run. And in today's video, which is part 2, we're going to talk about the S&P 500, more or less the rate hikes that we've seen over the course of the history, because that's obviously something we're experiencing at this time. What kind of effect did it have on the markets? How long did it take them to recover? As we look for clues as potentially when is the best time to start eyeing the bottom to be in, and maybe when to start accumulating some of our favorite coins in crypto or stocks, for the long term. Now, if that sounds interesting to you, please remember to like and subscribe, and let's go. It's TA with MK. It's TA with MK. So here we are on the SPX, or the S&P 500. This is the weekly chart, which is where we're going to spend the majority of our time. And just to give you kind of a quick run through of what you're looking at here, these green vertical lines on the chart will represent periods of time where they raised interest rates, essentially, and then these red vertical lines or red boxes will represent periods of time where they decreased interest rates. So for example, here on the left, if you look down, you can see that from June of 1999 through May of the year 2000, this green box is showing the 99 through 2000 .com boom, when the internet stocks were going crazy. Some of your things like Amazon and eBay, and of course of tons of others that didn't live to tell their story. And it shows, like, for example, here that over the course of that time, they raised interest rates. This is basis points. BPS stands for basis points. 175 basis points in 1 year. Now, if you see me looking over at this other direction, I'm just checking my other monitor to kind of make sure I'm matching up my notes correctly here. But the Fed rate hikes from 1999 through 2000, which is this green box. They actually raised rates 1, 2, 3, 4, 5, 6 times during that period of time in about a year. The majority of them were just 25 basis point rate hikes, and then the very last one, which was in May, the one that was represented by this green vertical line here, was a 50 basis point rate hike. Then just to the right of that, we have this red box, which represents the .com bubble, basically when it popped, essentially. This represents time frame between January of the year 2001 through December of 2001, where the Fed was lowering interest rates. On my cheat sheet over here, we show that there was 12, I believe, different times that they lowered interest rates, 25 or 50 basis points, nothing above that, but about half and half. About half the time they lowered them 50, half the time they lowered them 25. Basically, about every month during that year, they lowered, interest rates. And you can kind of see that this was happening while the market was basically on a large pullback or a decline, right, or a bear market. From there, I just want to kind of pull or drag price action over this way to kind of a future date and time. Now, this represents here, if you can see on my screen, from 04 to 06, this is what was known as the housing market boom. And I show here that there was 425 basis point rate hikes that took place over the course of a 2-year period. I can pull up my cheat sheet for that over here, and it looks like there was about 3, 6, 9, 12, 15 or 16 different times that they actually raised rates to kind of try to slow down that crazy boom that the economy was experiencing, especially in the housing sector. And it looks like basically every single one of them was a 25 basis point rate hike. However, you can see that the market during that entire time was actually still in a very, very strong uptrend. Then, just like before, if we fast forward a couple of years to follow those rate increases, you can see here that between 07 and 08, which was known as the housing market crash, they decreased rates or lowered them by 325 basis points over the course of an 8-month period. Pull up my cheat sheet here real quick. Looks like there were 7 different times during that 8 months that they lowered rates, 25, 50, and even a few 75 basis point decreases mixed in there. And then, we fast forward over here to what was known as, I guess, the Great Recession of '08. They decreased another 200 basis points. Looks like I put BSP. It's supposed to be BPS, sorry. Over the course of 3 months. And that was actually 3 different decreases. October of that year, minus 50. Later in October that year, another 50. So they actually did 2 just in that month of October. And then they lowered it by 100 one final time in December of 2008. So up to this point, the biggest takeaway I would have, is this was just a website that I used that kind of showed all of the major times in history that they've raised or decreased interest rates. And I don't know if that's all the times that they did it or just the major times. I haven't really done my research on that to this point, just being honest with you. But the big takeaway I've had to this point as it relates to these 2 major, swings within the S&P 500 is that when they were raising the rates, it was actually taking place in a strong uptrend. And you didn't really see the end of that uptrend, at least in this first case during the dot-com bubble, at any point during the rates being increased, right? Really, it peaked right after the rates were increased, or actually the peak happened right about the time that they did the last rate hike. Then the market kind of, rolled over and began to, be in a downtrend. And it wasn't for a whole year really, or at least 6 months before they started decreasing rates. And what you can kind of take away from that is it took the economy, more or less this much time to feel the effects of all of the rate hikes that were happening, right, over the course of that previous year. It took some time for that, those rates to hit the economy or for them to feel the effects of that, and for then, sell-off to start happening. And at that point, they decreased the rates, but you can see clearly that it took quite a while after that. In fact, if we use the date range tool, it wasn't for another year and a half almost before the markets really kind of found their bottom and began to start another uptrend. Same thing in this next series of rate hikes. You had rate hikes going on for 2 years. Now granted, they were only 25 basis point rate hikes. It wasn't anything crazy like what we're experiencing right now, which I'll go over shortly, but you still had over the course of 2 years 425 basis points increase, and the market actually didn't even find its top until nearly, wrong tool. That's not good. That's not going to get it done. Sorry, guys. Apparently I'm having a bit of a rough day, but you're looking at a year and, 3-4 months, before the market ever actually found its top. And this is after they stopped increasing rate hike, or, increasing the interest rates. And then, we look over here and just like before, you start having them decrease them while we're in a downtrend. This was how long it, took essentially for the economy to feel the effects of the previous rate hikes. And eventually, the market started to sell off. They decreased rates 2 different times, once here by 325 over an 8-month period. Market continued to collapse, even had a little bit of a capitulation right here in October of 2008. There may have been another catalyst. I haven't really done my research on exactly what that may be. Maybe I will post an image on the screen or something to kind of display what may have been the catalyst for that exact, big sell-off there. But at any rate, it led the Fed to decide to decrease rates another 200 basis points over that next 3 months. And then you still had another, even after that, still another, through 2.5, 3 months, really, before you even, saw the effects, before you saw the market find its bottom, essentially, is what I'm getting at, right? So I just kind of found that interesting that, at least with what I've looked up here, you've had the market continue to trend up during, rate increases, and the market to continue to trend down after rate decreases. So then we can fast forward even a little bit more in time, and we have this time frame, which we of course all know is the Black Swan event, which is known as COVID-19. And we know this is actually broken into 2 separate segments. I didn't do it on the chart here, but I will pull up my cheat sheet over here. Now, this actual rate decrease here didn't have anything to do with COVID itself. It was the 2019 mid-cycle adjustments over the course of 3 months, basically. They lowered the interest rates by 25 basis points each of those months, so it ended up being 75 basis points. Bam, COVID hits here, right? We have a huge sell-off. And then this one was referred to as coping with COVID, putting some money back into into the pockets of the people that were going to have to be staying home, keep the economy stimulated. They actually decreased rates twice during the month of March in 2020, once by 50, once by 100. So I just kind of grouped them together over the course of this time frame to show that they decreased rates by 225 basis points during the 8 months between mid 2019 and into the spring of 2020. So okay then, where does that put us today? Well, this is current price action for the S&P 500 here on the weekly chart, obviously, and you can see this is representing the rate increases that we're currently experiencing as we are in a downtrend. Now, the reason why I started this whole video out, and I will reference back to this several times, that is odd, is if you look back at the last 2 times in history that they were increasing the rates, it was actually during a giant uptrend in the market. Now, same thing here, increasing the rates, giant uptrend in the market. Now, from this point forward, a lot of my analysis in this video is going to be very speculative. I know there are way smarter people on this subject that could explain this to me, in probably 1,000 different ways. All of which are probably better than the way that I'm going to explain it or the correlation that I'm going to make. But I'm going to go with something kind of simple, at least to start here. And what I really think it is that the markets have gotten smarter. I mean, you would like to think that over the course of time, investors, humans adapt, they learn from their previous or past, mistakes. And in each of these past 2 cycles, in the history, we had a bunch of rate hikes happening. It took a while for the economy to kind of feel the effects of that. And once they felt the effects of that, they essentially began to sell off, right? At least, in this, it's going back to the dot-com bubble. That's kind of what I'm seeing there, is that, okay, the economy is going up and up and up, or stocks are going up and up and up and up and up. The Fed, to cool things down, starts raising rates over the course of that year. And really, people just kept rolling with it, probably thought it was going to the moon. Then they started running out of money because of, it's a little bit harder to have money in your pocket when everything's getting more expensive. And eventually, it starts selling off. Then the economy, or the Fed, tries to, kind of cool things or heat things back up, or at least, level things back out. But then, being the Fed and the way that they always are, they take a little bit too long to get that done. The economy continues to feel the effects of what happened back here, or maybe how long it took them to react to what was happening back here, and we continue to sell off, right? Kind of a similar thing here. It's just that it was a lot longer period of time with smaller rate hikes, so it took a lot longer for this to truly affect, the economy as a whole, and so this would continue to go up. But again, people probably should have been selling off sooner than they did, and because they didn't, eventually we had, a big crash start to happen, and then the Fed, I think, kind of foresaw it coming, tried to, save it a little bit by decreasing rates by quite a bit, actually, in a much shorter period of time. If you look back here, it was 425 basis point rate hike, but it took them 2 entire years to do it, so very much of a slow process. Well, here, as it started to roll over, they decreased it by 325 in only a year. So quite a contrast there during this market crash. And then, of course, the economy just really took a big nosedive right here. The Fed decided to decrease rates even more in a very short period of time of 3 months. Boom, we find our bottom eventually, recover, and off to the races again. As we jump back to current price action on the S&P 500, let me kind of explain a little more in depth what I mean by the market got smarter, because really, at the end of the day, it's not this simple as that. I know that makes it sound a lot simpler than it really is. Truly, there's 2, probably 3 or 4 or 5 different parts to all of this, but the 2 main parts to this that I'm going to focus on. Number 1, we all know that during the COVID-19, that because people had to stay home and stuff, the Fed printed money, print. They got a little print happy, and they basically kicked the can down the road, knowing that eventually this was going to be what they would have to do to cool the economy off, because give everybody a bunch of money. What do you think is going to happen? That being said, at the time, it's what they felt they needed to do. I'm not here to talk about how I feel about all of that, but at the end of the day, I do believe there was probably other potentially better ways they could have handled that. That's a different debate for a different day. But that being said, at the end of the day, because of what they did, we knew this was coming eventually, right? And some of your more sophisticated market participants that have, as the market has, matured over the years, and especially nowadays where there's so many more traders in the market, we're not a market full of just investors anymore like we would have been, years and years ago. We now have a market full of traders, which means lots of people are looking to get in for short periods of time and out and in and out, whereas maybe in the past it was a lot more buy, hodl, hold, maybe only sell at major, reflection points in the market. But at this point, the market's gotten more sophisticated, and I think what the difference was between the dot-com bubble in a sense and now, really, or even some of the other recessions in the past, is that, number one, the Fed had hinted pretty early on, months and months before they ever did raise the rates, that it was likely to be what they were going to do. So the market kind of knew it was coming and essentially ran that idea, right? And so that's what we're kind of seeing. We're seeing a pullback, at least the first major pullback in history that was happening during a very major, rate increase. And that is different than what I've shown you, at least on the charts up to this point, right? Okie dokie. So all that being said, to me, there's basically one major, most likely scenario out of all of this, and then maybe one that's a little less likely, but still possible. And I'm going to quickly cover both. The first one we want to cover is the more likely scenario. And that, to me, that is that, just like you would expect, and has happened in the past, at least, whenever they start to increase rates, there's a certain period of time it takes for that to really hit the economy hard, especially, in this case, they're doing pretty substantial rate increases over the course of just however many months so far. Just this last year, they've increased rates by 375 basis points. You would expect sometime in the next 6 months for that to really hit the average person, because we all know prices of things going up, it takes a little while before it starts bleeding out. The money that you're used to having, you eventually don't have anymore, and then then there's even layoffs and unemployments that happen, and then people start taking out their 401ks, things like that. And then, of course, that naturally brings the price of stocks down, right? Well, like I said, the effect of that takes so long to feel. We're already in a downtrend. Now, what you would expect at some point is a little bit of what we'd like to see, a capitulation, maybe in the first to, middle part of next year, big dip, right? Sometime in there, either right before it potentially happens or maybe right after it happens. Knowing the Fed, probably right after it happens, you start to see them slash rates a little bit. But guess what? Same as up here. It takes a little while for the economy to feel the positive effect of those. And so it'll either range for a while, or maybe we even see a little dip lower. Now, we'll talk about ranges kind of in the next video. My next video, which will be the third part of all this, we're going to tie it kind of together to really give kind of my predictions and where I will be looking, or time frames I'll be eyeing to buy stuff. But for here, we're just kind of talking more about the idea that you would see kind of a major capitulation in the market at some point, kind of as people adjust to not having money, essentially, and then you kind of have an accumulation phase at that point, and then eventually we recover. We feel the effects of the rate decreases that are inevitable to me at some point. Maybe not all 375 of these being decreased back, but maybe half of it or something, right? And then we recover sometime maybe in 2024, 2025, as far as your traditional markets go, right? Now, to cover the less likely scenario, we want to kind of go back to the dot-com bubble, which is also going to be something that'll tie into our third video as we talk about Amazon and eBay, a few of the stocks charts that I think kind of could be mirroring a little bit of Bitcoin going into what might be our modern day dot-com bubble, right, within the crypto space. But anyways, again, because I think the markets have matured to this idea of, okay, we need to maybe sell a little bit early during these rate increases, or even ahead of time in this case, to just to make sure that, before the economy really feels the effects, that we're out of our positions, or that we've got money on the sidelines, right, to buy the dips if you're a trader or an investor or whatever, right? And, of course, like the dot-com bubble, it was in a major downtrend before the Fed, decreased rates, and it took quite a bit of time afterwards for the market to recover. The less likely scenario to me is that because the market got smarter and actually kind of front ran the idea of these rate increases, the sell-off began prior. What I could see happening, which is something that I'll be prepared for, is the idea that if there's any hint of the Fed possibly decreasing rates, and this might actually start just with the simple pivot of them stopping raising them for a bit. That's what they kind of call the Fed pivoting to a sense. Even they just stop raising rates for a bit and then they start hinting at a future decrease of some sort, you might actually see a bit of the market kind of cool off a bit from here. A little more downside over the next, few months, maybe the first few of next year as kind of the effects of this is felt. But then you kind of have a quicker accumulation phase and a quicker recovery. And it does the opposite of what we saw in the dot-com bubble, where the downtrend happens during the majority of the rate increases, and the uptrend actually is happening when they're decreasing the rates, if that makes sense. The idea would just be that the Fed steps in, they actually raised rates super, super quick here, to kind of crash things, maybe to save themselves from themselves in a sense. They also then turn around and quickly, either print some more money or decrease rates, kind of to keep things from doing a capitulation essentially, right? They're trying to avoid this. We kind of see more of I wouldn't call it a V-shaped recovery, but just more of a quicker rounded bottom, a shorter recession, something where, we're back up to maybe even these highs by the end of next year, but rather than being 2023, maybe by the end of before 2024, maybe by the end of 2023, we're already seeing ourselves trending back up to these levels. So it's something I'll be keeping an eye out for. To me, it's a less likely scenario. I like to think that the traders are what got smarter. Some of these big money whales that decided to front run selling off the rate hikes, but I don't know that retail necessarily has gotten smarter or even really know what's going on. And so at the end of the day, when they have to sell, some of their stocks because they're out of money, what's left of their 401ks, things of that nature, inevitably I think you see a capitulation, and I'll be watching for that because to me that'll be the best buying opportunities. Of course, if it doesn't happen, really we'll just be kind of eyeing everything more from a time frame perspective, which again in our third video we'll tie it together as we kind of compare what we forecast on the S&P 500, plan A, plan B, of course, what we kind of see as far as Bitcoin halvings go, and then comparing Bitcoin to Amazon and eBay. So be watching out for that video. Rubble rubble ding dong, walla walla schling schlong. Thank you very much for sticking around to the end of the video. I do appreciate you guys as always, and if on your way out you could do me a huge favor and remember to like, and if you're not subscribed, do that as well, and we'll catch you in the next one. It's TIMECODES.